Good afternoon, everyone. As usual, today we are at you through our weekly FB Live on Thursday afternoon, 12 p.m. CST. Every week, we are putting efforts to bring some new knowledge and to share with that knowledge with you guys. So, as usual, today we are with a new topic about charitable donations. Very important point because we all are successful people here in America and we do a lot of charities. Charity, we do donations, we do contribute in kind donations also, we do not only cash. Whatever we do, the charities, always we have the question, do I get a tax benefit or not? That's what we are going to talk today. So let's do a deep dive and I will share my screen now and from there we'll go. So all our intention for putting these efforts to bring the knowledge to you is whatever money you are making in the year, 30 to 40% it is going as a taxes. We are giving our effort to share the knowledge so that you can keep the money what you earn with you to the extent possible. So in that every week there is a new topic. Every week we request you to come join with us, learn something new, and ask your questions. Feel free to post your questions in the chat box or in the comments box. We are happy to answer all your questions there. And as usual, very brief about me. So I have 20 years of experience. I'm Anil Grandi. I'm the CEO of 𝐤𝐲 Tax. I have 20 years of experience in the core finance, tax, and accounting fields, and I work for Amazon, Starbucks, PricewaterhouseCoopers, and Sun Edison. I also have been serving as a Forbes Finance Council member and written a lot of articles. Today, with me, my colleague Abhishek Gandhi, CPA, and our tax director is also here to share our knowledge with you. Today, our focus would be on amplify your impact with charitable giving and tax advantages. Very important topic. So, Abhishek, can you take it
Hi,
over?
sure. Thank you, Anil. And hello, everyone. Today, I am excited to talk about how you can amplify your impact through charitable giving and explore the potential taxes. This is a very, as Anil said, this is a very wide topic, and we all are donating once in a while. Everyone, we like to donate. We like to help our society, and and we do donation in cash, in kind, and so many things. But navigating tax implications, that is a little bit overwhelming for us today. I want to i want to demystify the process and empower you to maximize your charitable impact and explain how you can potentially reduce your tax burden. So let's understand of charitable contribution. What is a charity, first of all? Because sometimes we donate, but we have to donate to get a benefit, to get a tax benefit. We have to donate to certain institutions. So let's focus a little bit. Let's talk about it. So first, let's define charitable contribution. And these are the donation made to a qualified organization like religious groups, educational institutions, and public charities. These donations can be in the form of, as I said, cash, properties, or even assets, right? So IRS define it like cash contribution and in-kind charitable contribution. Now, as I said, qualified organization. What is qualified organization? This is very crucial to ensure your donation goes to a qualified organization like Goodwill or any other. The IRS provides a convenient tool on their website. If you will go there, you will find, you just type it and the exempt organization search. If you will do this search, you will find you will verify the status of that particular organization. If they are in the list, then you're good to go. Here, one more thing we need to remember, because so many people ask me so many times that we have contributed to foreign countries, maybe in India. We like to help our own people, and sometimes what happens that we want to take a tax benefit also, but mostly mostly organizations generally in out on offshore, out of the country, they are not deductible unless tax treaty exists between US and that specific country. You may donate it to either in India or Africa or any other country, but you have to find out whether US has that treaty with that particular country. Now, another important area is a record keeping. We have to keep a proper record for donation that we give. So record keeping is the foundation. It is called a foundation for the deduction. If you want to go, if you want to deduct that as a, you want to get the tax deduction, then we have to keep a proper documentation. This is very essential for claiming tax deduction on your contribution. So the requirements vary depending on the type and amount you donate. Correct? So let me explain a little bit. Like for cash contribution under $250, a bank record or a receipt from the charity is sufficient. Or for a larger donation, like over $250, right? A written acknowledgement from that charitable institution detailing the amount, any good or services received that should be received in return, everything should be written down. Of course, their fair market value, estimated value is also necessary. So it is easy when you donate a cash, but it gets little complicated when you donate services or you make in-kind charitable contribution. So non-cash contribution has a similar guidelines. As I said, that when there is a cash contribution and there is a in-kind charitable contribution. So when there is a non-cash contribution, there are another added requirements, additional requirements for higher value donation, like qualified appraisal for items exceeding $5,000, right? If you donate your car or something valuable, right, or stock or bond, then you have a added requirement. So now another is, let's talk about filing and limits, right? So we have to look into it, that what are the filing and what are the limits for it. To claim these deductions, you will need to itemize deduction on Schedule A for your tax return. This is very important. If you do standardized deduction, then you will not be able to claim your charitable contribution. So you have to make sure that you have to do itemized deduction. Now again, IRS has set limits on deductions. These deductions are generally 60% of your AGI. We all know what is AGI. AGI is an adjusted gross income. So you can claim up to 60% of your AGI if you do the cash contribution. Now, it also depends on an organization, but this is a top limit. Now, again, for non-cash contribution, typically you have a 50% of AGI limit. Normally, this is between 30% to 50% when it's an in-kind contribution. So one another thing here we have to remember, that don't let excess go to waste, right? Because sometimes we may not be able to use full contribution. Maybe you contributed $10,000, and due to some reason you are not able to claim all 10,000, and remaining part of that money you can carry over. So if you're, as I said, if your contribution exceeds the AGI limits, right, then you can carry forward this excess amount for up to 5 years to use against future access to future taxes. So there are special consideration for that too. These special considerations are there to maximize your impact. There are special consideration for specific type of donation, like for vehicle donation, you have to do the market value, and this market value may be deductible, but additional documentation are applied. We have to apply additional documentation like a fair market value, what is a what was the purchase price, how did you obtain it, all those kind of documentation need to be attached. Donating appreciated stock, that is another that is another another thing that people like to donate, and that offers additional benefit by potentially avoiding capital gain tax, right? If you donate your stock, then you don't have to pay capital gain tax. Now, for that, you have to do some planning. You have to make a strategies. So how you will make those strategies? So now let's explore some tax planning strategies to maximize your charitable giving impact. What you can do here, like one of the very popular tactics here is a bunching donation. What this does is it involves consolidating donation from 2 years into one exceed standard deduction threshold and maximize your itemized deduction for that specific year. Let me explain a little bit. So what it means is, like if you accumulate, if you combine 2 years of your donation, right? And like one year you donated 5,000, and another year you donated another 5,000. So totally now you have $10,000, and together you can go for that deduction. So that will help you claiming this claiming this charitable contribution. Another is a long-term appreciated assets. What are long-term appreciated assets? Donating these assets like long term, when you have certain things like a house or stock or anything that is appreciated, you bought it for 100,000 and now it's maybe 1 million. Donating these assets, that will eliminate your capital gain and capital gain tax while allowing a full fair market value deduction. So this is a very powerful strategy. If you will see, sometimes if you will donate this, and again, you will get a tax deduction from the fair market value. So due to this estate planning, charitable giving can be incorporated in your estate plan. Naming a charity in your will or as a beneficiary of qualified accounts can reduce or it can eliminate also the estate tax for your heirs. So not just you, but now your heirs will be benefited by this too. Another one is a donors advised fund. This is a specialized account. You might have heard about donors advised fund. If not, then let me tell you something, that this is a specialized account for charitable giving. So you receive an immediate tax deduction upon contribution and can recommend grants to qualified charities over time. While the fund grows, it is tax free. So all these are very powerful strategies. We may think that okay, charitable contribution is just donating old clothes or old furniture, but it's not. There are so many things. So in a nutshell, the bottom line is charitable giving is a powerful way to support causes you care about while potentially reducing your tax burden too. By understanding the guidelines, record keeping requirements, and available strategies, make you can make a significant deduction in your tax liability, and you can maximize your impact. So this is it for the day. Anil, it is if you want to add anything to this, I would really appreciate that. Thank you.
Thank you. Thank you very much. Thanks, Abhishek, for very nicely covering all the strategies about charitable donations or charitable giving. So, just I want to add a couple of more points. As we all make money, we also have the responsibility to give back to the community. And our government and IRS are encouraging us to do more charities so that we can also enjoy the tax benefits on this. So for every dollar you donate, you enjoy the tax benefits. But very important, you can to enjoy the charitable donation tax benefits, you need to file itemized tax return only. If you are filing a standard tax return, then you know you won't come under getting any tax deductions. What is the difference between standard tax deductions and itemized deductions? We have done an exclusive session on this in our previous live sessions. You can go back to our any of our social media channels and you can view those the difference between itemized and standard. Then now coming to the charity, and so can I donate how much money I want? No, answer is no. There to get that, no, you can donate, but you will not get a tax deduction for the entire donations because there is a restriction on that. Only 60% of the donation of the AGI adjusted gross income can be eligible as a tax deduction. If anything more donation, if any more donations you have done, you don't need to worry. You can carry over these tax deduction credits to the future periods up to 5 years. Very, very important. And the other important point, generally to do the charities, what we do, but if we really made so much of money, maybe in the stock market or in the real estate, what you do is you sell those properties or assets, you pay capital gain taxes, and from there you are doing some charity to some non-profit organization. Rather, you can even donate these appreciated assets, maybe some stock. You can donate it and you can enjoy the tax deductions on the fair market value itself. You don't need to pay capital gain taxes on the stock whatever you are donating here, and because you are enjoying a tax deduction at fair market value. Very important. And the other one, donor advisor fund, very, very, very well covered by Abhishek. So if you are not very sure to where to donate or to which organization you want to donate, because all organizations are not eligible to to get a tax deductions, you have to donate to only 501c3 organizations only. If you are not yet sure to whom you want to donate, you can open an online account, maybe with a Fidelity, Vanguard, and a lot of other service providers are there. You can open donor advisor fund. You can do the donations into that account. Once you donate the money, you enjoy the tax deductions in that year. And this money can be used for any donations in the future period. There are no time limits applicable here. And the money can, till you donate, this money can be invested into the stock market. So whatever appreciation you are getting in the donor advisor fund, you are enjoying the tax-free growth also. But point to be noted, you cannot take back the money from your donor advisor fund to you again because you already enjoyed the tax benefits at the time of donation. So this is one of the great tax planning tool for donor advisor fund. Even I personally also have donor advisor fund account where at the end of the year I look into all my numbers and I do some charity donations into this. I'll put some money into the donor advisor fund. And I hope this is helpful for every one of you. And if you have anyone has any more questions, feel free to post your questions in the comments box. It can be in the Facebook, Instagram, LinkedIn, or Twitter. We are happy to answer any of your questions. On the Abhishek, do you see any questions?
No, not yet. So
Okay,
far, I don't see questions.
no problem. Okay, thank you very much. Then again, we will see you back again on next Thursday at 12 p.m. CST with some new topic. New topic. Meanwhile, if you are watching this session in a recorded, feel free to post your questions in the comment box. We will answer every question to the extent possible from all our social media channels: YouTube, Facebook, LinkedIn, Instagram, and also Twitter. See you soon next week, Thursday afternoon, 12 p.m. CST. Thank you. Bye bye.